At the latest official reading, the California Department of Insurance displayed a market signal larger than a fire perimeter, with 668,609 fair plan policies and 662 distressed zip codes. One signal would be unusual. Several signals together are harder to dismiss. According to NOAA's disaster record, California has already been affected by $19 billion wildfire events since 1980. According to the state insurance department, more than 8.3 million homeowner policies still sit outside the FAIR plan, while the last resort plan itself is being tracked as a market stability signal. And across the state, distressed zip codes now mark places where wildfire risk and insurance access are colliding on the official map. But that is not the most dangerous part. The headline is not only the next fire. The hidden number is how many households are being pushed away from normal coverage and toward the insurer of last resort. This is not just wildfire risk. This is an insurance fault line. A fire can end with containment. An insurance gap can keep moving through a household long after containment. So the question is no longer simply where California will burn next. The question is what happens when wildfire risk reaches the policy, the mortgage, the rebuild, the contractor, the local tax base, and the family trying to stay insured. Like, subscribe, and comment where you are watching from, because this map is not only showing fire danger, it is showing where recovery may break first. But the first clue is not on the fire map. It is on the insurance dashboard. At the latest official reading, the first dashboard was not a flame map. It was an insurance map. That matters because California's wildfire crisis no longer begins only when a smoke column rises over a ridge, or when a sheriff issues an evacuation order, or when aircraft begins circling above a burning canyon. It begins earlier now. It begins when a household opens a renewal notice. It begins when an insurer stops writing new policies in a zip code. It begins when a broker says there are fewer options than there were last year. It begins when a state regulator has to track not only fire danger, but whether the ordinary insurance market is still functioning in the places most exposed to fire. At the center of that dashboard sits the California Department of Insurance. Its job is not to forecast wind. Its job is not to command firefighters. Its job is to watch the market that is supposed to help people recover after disaster. And on that market dashboard, several warning lights are already active. One light is the FAIR plan. The FAIR plan is not designed to be the normal first stop for homeowners. It is the insurer of last resort, the place a household turns when it cannot find coverage through the standard market. In a stable system, the FAIR plan should be small enough to remain a backstop. It should catch the households that cannot find reasonable coverage elsewhere, not become the main route for large parts of the state. But California's own insurance department now tracks FAIR plan policy count as a market stability signal. That is the first clue. A policy count can sound dry. It can sound like paperwork. But inside that number is a question every homeowner understands. Can I still insure the roof over my head without being pushed into a last resort system? The second warning light is the distressed zip code map. The state has identified hundreds of zip codes where insurance access has become strained enough to require official attention. These are not just places with trees. They are not just places with dry hillsides. They are communities where wildfire hazard and insurance availability are now overlapping on the same official map. The fire risk is physical. The insurance risk is financial. The household experiences both at once. The third warning light comes from NOAA's disaster record. According to NOAA's National Centers for Environmental Information, California has already seen $19 billion wildfire events since 1980. That number does not describe ordinary bad seasons. It describes a repeated pattern of disasters large enough to enter the National Billion-Dollar Disaster Database. Each event becomes part of the memory of the market. Insurers remember it. Reinsurers remember it. Regulators remember it. Homeowners remember it through premiums, coverage limits, non-renewal letters, and the growing difficulty of finding a normal policy in a high-risk area. On their own, these signals could be treated separately. The FAIR plan could be treated as an insurance issue. The distressed zip code map could be treated as a regulatory issue. The NOAA disaster count could be treated as a climate and hazard issue. The homeowner policy market could be treated as a consumer issue. But together, they describe one larger configuration. This is not just wildfire risk. This is an insurance fault line. That fault line runs through more than one system at once. It runs through the hills where dry vegetation can become fuel. It runs through neighborhoods built near that fuel. It runs through the insurance models that estimate future losses. It runs through the reinsurance market that helps insurers survive catastrophic claims. It runs through state rules that decide how much future risk insurers can include in prices. It runs through a family budget when the premium arrives. It runs through a mortgage when the lender requires proof of coverage. By the time fire becomes visible, the system may already be carrying load. That is why the day has to be read like an operations room, not like a weather report. Picture the room. On one screen, there is a map of California's fire-exposed landscape. It shows mountains, canyons, foothills, forests, grasslands, and communities built into places where wind and fuel can meet. This is the map people expect. It is the visible map. It shows where flame could move. On a second screen, there is the insurance market. It does not show flames. It shows households. It shows policy counts. It shows zip codes where coverage is harder to obtain. It shows how many people remain in the standard market and how many have been pushed toward the fair plan. This map is quieter, but it may be more revealing. On a third screen, there is the disaster history. NOAA's billion-dollar data stretches back decades, not as a memory book, but as a ledger. A ledger is different from a headline. A headline tells you what happened. A ledger tells you what keeps happening. On a fourth screen, there are insurers and reinsurers deciding how much wildfire risk they are willing to carry. They are not only asking where the next fire might be, they are asking how large the next claim wave could be. They are asking whether construction costs have changed. They are asking whether smoke damage, debris removal, temporary housing, rebuilding delays, and litigation will make the next event more expensive than the last. On a fifth screen, there is the household. This is the screen that matters most, because the household is where every abstract signal eventually arrives. A family does not receive a catastrophe model. They receive a bill. They receive a renewal offer. They receive a non-renewal notice. They receive a quote that is higher than expected. They receive a broker's sentence that changes the room. There are not many options left. That sentence is not a fire, but it can still move through a life. It can change whether a family keeps a house. It can change whether a retired couple can stay in the community where they plan to age. It can change whether a buyer qualifies for a mortgage. It can change whether a landlord raises rent. It can change whether a town still has a stable tax base after repeated disasters. It can change whether recovery is possible before the next load arrives. The map shows hazard, but the market shows recovery capacity. That is the abnormal pattern. California is not only dealing with fires that can produce billion-dollar damage, it is dealing with the slow conversion of fire risk into insurance stress. And insurance stress is different from fire damage. Fire damage is visible. Insurance stress is often invisible until a deadline arrives. A fire announces itself with smoke. Insurance stress announces itself with paperwork. A fire moves through fuel. Insurance stress moves through contracts. A fire forces evacuation. Insurance stress can force a household into a more expensive, narrower, or less stable version of protection. A fire may be contained in days or weeks. An insurance gap can remain after the engines leave, after the news crew leaves, after the air clears, after the ash is cleared from the driveway. This is why the official signal matters. A state does not build a sustainable insurance strategy because everything is normal. A regulator does not track distressed areas because the market is functioning easily. A last resort plan does not become a central market indicator because risk is isolated. These are institutional signals. They are the equivalent of warning lights on a control panel. And the control panel is not showing one problem, it is showing a chain. The chain begins with hazard. In California, wildfire hazard is shaped by fuel, wind, heat, dryness, topography, and the location of homes. A house does not need to sit deep in a forest to be exposed. Embers can travel, wind can carry burning material across roads. A neighborhood can be surrounded not by giant trees, but by grass, brush, fences, decks, sheds, and other structures that become part of the fire environment. Then the chain moves into exposure. Exposure means what stands in the path of loss. Homes, apartments, schools, small businesses, electrical lines, water systems, roads, clinics, fire stations, cell towers. If more value sits in fire-prone areas, the potential loss grows even before the next ignition. Then the chain moves into cost. Rebuilding a house is not only about replacing walls, it can involve debris removal, environmental testing, temporary housing, code upgrades, labor shortages, material prices, permitting delays, and contractors stretched across a disaster zone. An insurer is not only pricing the chance of flame reaching a structure, it is pricing the cost of making a household whole after the structure is damaged or destroyed. Then the chain moves into modeling. A model is not a prophecy, it is a tool for estimating risk. But when past losses no longer feel like enough, insurers look harder at forward-looking models. They ask what future fire behavior, future construction costs, future claim severity, and future concentration of risk might mean. That question can change prices. It can change underwriting. It can change whether coverage is offered at all. Then the chain moves into regulation. Insurance is not sold in a vacuum. State rules shape how insurers file rates, how they justify those rates, what data they can use, and what obligations they accept in return. When the state allows forward-looking catastrophe models, it is not a technical footnote. It is part of a bargain. Insurers get a way to price future risk. Consumers are supposed to get more availability in places where coverage has become difficult. Then the chain reaches the household. That is the endpoint people feel. The forecast may show fire weather. The household receives financial weather. A premium, a notice, a coverage limit, a deductible, a lender requirement, a deadline. This is the day California is already inside. Not a single day on the calendar, a day in the system. The moment when several official signals line up and begin pointing at the same underlying problem. At the top of the dashboard, the fire history is no longer abstract. $19 billion wildfire events mean the state has already been hit repeatedly by events large enough to change expectations. They are not isolated memories. They become inputs. They become evidence for future risk. They become arguments inside rate filings. They become reasons insurers ask whether the old approach can still hold. Below that, the FAIR Plan number keeps asking a different question. How many households are no longer being served by the ordinary market? That question matters because last resort coverage is not just another brand name. For many households, it can mean a more complicated insurance structure. It can mean needing separate coverage to fill gaps. It can mean more paperwork. It can mean higher costs. It can mean less confidence that the household's protection looks like what it used to look like. Then the distressed zip code map asks an even more local question. Where is the pressure concentrated? A statewide number can hide the street-level reality. A household in a lower-risk urban area and a household on a fire-exposed hillside may both live in California, but they are not facing the same market. One may receive ordinary choices. The other may find that ordinary choices have narrowed or vanished. Distressed areas show where the market problem has geography. This is where the story stops being about weather alone. Weather can help ignite the crisis. Climate can load the dice. Land use can place more value in harm's way. Vegetation and wind can decide how a fire moves. But insurance decides something different. It decides whether recovery has a financial bridge. Without that bridge, disaster does not end when the hazard ends. A family can survive the fire and still lose stability afterward. A town can survive the flames and still lose residents because rebuilding is too expensive or too slow. A neighborhood can remain physically standing and still become harder to sell, harder to finance, harder to insure, and harder to trust. That is why the dashboard matters before the flames arrive. The insurance map is not predicting the next ignition. It is showing where the next disaster may become harder to recover from, and the most important part is that none of these systems fails all at once. They bend first. A premium bends, a renewal bends, a broker network bends, a claims office bends, a last resort plan bends, a household budget bends, a town budget bends. Then one more event arrives. That is the operational picture. California has a fire problem, but it also has a recovery architecture problem. The architecture includes insurers, reinsurers, regulators, lenders, homeowners, contractors, local governments, and emergency systems. Each part can look separate on paper. In a disaster, they become one machine. If one part slows, the others feel it. If claims are delayed, rebuilding slows. If rebuilding slows, displacement lasts longer. If displacement lasts longer, schools, businesses, and local budgets feel the strain. If insurance becomes harder to obtain, property transactions slow. If property transactions slow, household wealth and community stability become less certain. If the FAIR Plan absorbs more risk, The last resort system becomes more important at the exact moment it is under more pressure. That is the configuration now flashing on the dashboard. A fire season is not just approaching a landscape. A financial load is approaching the systems that decide whether people can remain in that landscape. The state can thin vegetation. A homeowner can harden a roof. A community can create defensible space. Firefighters can attack a perimeter. Regulators can change rules. Insurers can return to some markets if they can price risk. But every one of those actions takes time. And time is the hidden clock in the operations room. The fire can arrive quickly. The insurance repair takes longer. That is why the day feels abnormal. Not because one number is large, but because several official signals now describe the same direction of travel. Fire risk is moving into insurance access. Insurance access is moving into household stability. Household stability is moving into community recovery. The smoke may not be visible yet, but the dashboard is already lit. And the next number is the one that made this fault line impossible to ignore, because $19 billion wildfires are not just disasters in the past. They are the system memory that shapes what coverage looks like now. The headline number is 19. According to NOAA's National Centers for Environmental Information, California was affected by $19 billion wildfire events from 1980 through 2024. The same state summary lists $46 billion weather and climate disasters affecting California over that period. In other words, wildfire is not a minor category inside the state's disaster ledger. It is one of the central forces shaping that ledger. But the word billion can become too large to feel. $1 billion is not just a big number. It is a scale at which individual losses stop staying individual. One house is a family crisis. One burned street is a neighborhood crisis. One destroyed town is a regional crisis. But $1 billion wildfire event becomes something else. It becomes an event large enough to move through insurance reserves, reinsurance contracts, state emergency systems, federal disaster programs, construction labor, debris removal, public health, school districts, local budgets, and the financial decisions of people who were never near the flame front. That is why the number matters. 19 is not only a count of fires, it is a count of times the state's recovery system had to absorb wildfire at a catastrophic economic scale. It is a count of times the market learned something. It is a count of times insurers, reinsurers, regulators, homeowners, lenders, builders, and local governments were forced to ask whether the old assumptions still worked. The number is not just disaster history, it is the actuarial memory of the state. That phrase matters because insurance is built on memory. The market remembers loss through data. It remembers neighborhoods through claims. It remembers houses through construction costs. It remembers hillsides through fire behavior. It remembers wind corridors through modeled exposure. It remembers rebuilding delays through claim severity. It remembers smoke damage through disputes that outlast the fire. A person may remember a wildfire as a day. An insurance system remembers it as a future price. That is the first reason 19 is abnormal. It turns wildfire from an event into a repeated financial signal. If California had $1 billion wildfire event in 44 years, the market could treat it as an extreme outlier. If it had 2 or 3, the system could still argue over whether they were unusual but rare. But 19 events create a different question. They do not say that every year will produce the same disaster. They do not predict the next ignition. They do not prove that every premium increase has one cause. But they do show that billion-dollar wildfire loss has become part of the state's modern operating environment. That changes the room. Before a fire, the headline question is usually where it will burn. After a fire, the headline question is how much damage it caused. But inside the insurance system, the question is quieter and more durable. How often should we expect this kind of loss? That question is not emotional, it is structural. If the expected loss rises, the market has only a few places to send that pressure. It can send it into premiums. It can send it into stricter underwriting. It can send it into higher deductibles. It can send it into reduced availability. It can send it into more reliance on the FAIR plan. It can send it into reinsurance costs. It can send it into rate filings. It can send it into political conflict over affordability and access. This is where the headline number begins to move. It moves from NOAA's disaster ledger into a homeowner's renewal envelope. It moves from a national database into a broker's phone call. It moves from a state summary into a mortgage requirement. It moves from the past into the next policy period. That is why 19 cannot be treated as a museum number. It is not sitting behind glass. It is active. To understand its size, compare it with something ordinary. A household budget is built around monthly payments, mortgage, insurance, utilities, food, gas, repairs, medical bills, school costs. A family can plan around routine expenses because those expenses have shape. They arrive on a schedule. They may hurt, but they are expected. A billion-dollar wildfire event has the opposite shape. It breaks schedule. It compresses thousands of private losses into one public disaster. It arrives as flame, smoke, evacuation, debris, claims, temporary housing, business interruption, rebuilding, and months or years of administrative delay. Now multiply that category of event by 19. Not 19 burned houses. $19 billion wildfire events. That is a different scale of repetition. It means wildfire has returned often enough to become a standing assumption in the system that insures property. And when an assumption changes, the consequences are not limited to the places that already burned. A homeowner in a fire-exposed area may never have filed a claim. The house may still be standing, the roof may be intact, the driveway may never have seen ash. But the market around that house can still change because the model is not only looking backward at that one address, it is looking at expected loss across a geography, across a class of homes, across a concentration of risk, across future fire behavior, and across the cost of recovery if many structures are damaged at once. This is the second reason 19 is abnormal. It does not have to touch every home directly to affect many homes indirectly. A fire burns physically, the number spreads financially. That spread is not always dramatic at first. It may appear as a higher quote. It may appear as a company no longer offering new coverage in a particular place. It may appear as a renewal that arrives with new conditions. It may appear as a homeowner being told to clear vegetation, improve defensible space, update a roof, or accept a different policy structure. It may appear as a shift from a standard carrier to a last resort plan. The flame may be miles away. The policy change may arrive anyway. That is the operational meaning of a billion-dollar disaster record. It turns geography into probability. It turns probability into price. It turns price into access. And access becomes the real test of recovery. A house without affordable, adequate insurance is not just a private inconvenience. It is a weak point in a larger system. Lenders require coverage because the house is collateral. Communities rely on stable property values because property taxes help fund local services. Families rely on home equity because it is often their largest store of wealth. Local contractors rely on rebuilding demand that can actually be financed. Cities and counties rely on residents returning after disaster, not scattering because the financial bridge collapsed. So when $19 billion wildfires enter the record, they do not stay inside Noah's table. They enter the banking system. They enter household budgets. They enter city planning. They enter state regulation. They enter the question of who can afford to live in high-risk California and under what conditions. This is not just wildfire risk. This is an insurance fault line. The number also becomes abnormal when placed against the older mental calendar of wildfire. For many people, wildfire once sounded seasonal. Late summer, dry autumn, Santa Ana winds, red flag warnings, fire crews on alert, evacuation maps, smoke, then rain, then recovery. That old calendar was never perfectly safe, but it gave people a rhythm. There was a season of preparation, a season of danger, and a season of rebuilding. Insurance does not follow that simple rhythm anymore. A renewal notice can arrive months before fire season. A rate filing can be debated long before the next ignition. Reinsurance decisions can be made on a global calendar that has nothing to do with a single California town. A homeowner can be pushed into the FAIR plan during a quiet weather week. A buyer can lose a mortgage opportunity because coverage is too expensive before a spark has fallen. The disaster calendar and the insurance calendar are no longer aligned. That is one of the most important meanings of the headline number. $19 billion wildfire events do not just tell us fires have been expensive. They tell us the cost of fire has become durable enough to affect ordinary time. The risk moves into months when the sky is clear. It moves into paperwork. It moves into underwriting. It moves into financial planning. It moves into whether families feel secure in a place before the next emergency. The number is not just fire being larger. It is time being pulled out of position. A billion-dollar wildfire event is also abnormal because it tests systems that were not designed to all peak at once. Firefighters face the perimeter. Utilities face damaged lines. Water systems face pressure demands and contamination risks. Hospitals face smoke-related illness, evacuations, and staff disruption. Roads face evacuation traffic. Shelters face displaced families. Schools face closures. Local governments face emergency spending. Insurers face claim volume. Contractors face rebuilding demand. Regulators face consumer complaints. Banks face collateral risk. The event is visible outside. The damage begins inside the system. And if the system has not recovered from the last load, the next one arrives on a weakened foundation. That is the part a headline can miss. A news headline may say a fire caused billions in damage. But the deeper story is what happens after multiple billion-dollar fires teach every institution to expect more loss. The market does not wait for certainty. It reacts to perceived risk. It reacts to accumulated evidence. It reacts to the possibility that the next event may be worse, more expensive, more urban, more legally complex, or more difficult to settle. That reaction can protect insurers from insolvency. It can also leave households exposed. Both things can be true. An insurer can be responding rationally to rising loss potential. A homeowner can still be trapped by the result. A regulator can be trying to preserve market availability. A family can still face a bill it cannot absorb. A community can support wildfire mitigation and still lose residents if insurance becomes unaffordable. A state can need accurate risk pricing and still have to ask what happens to people who cannot pay the price. That is why the number has to be read carefully. $19 billion wildfire events do not mean California is doomed. They do not mean every house in a fire-prone area will burn. They do not mean every insurer decision is identical. They do not mean one cause explains every market change. But they do mean the old story is too small. The old story says wildfire is an emergency response problem. The new story says wildfire is also a property finance problem. The old story says the fire ends when it is contained. The new story says the economic event can continue through insurance, rebuilding, displacement, and affordability long after containment. The old story says the danger is on the ridge. The new story says part of the danger is in the policy file. This is how the headline number appears in real life. It appears when a homeowner who did everything right still struggles to find coverage. It appears when a broker says the standard market is limited. It appears when a family compares the cost of insurance with the cost of staying. It appears when a town worries that rebuilding will be slower than memory. It appears when a lender will not close without proof of coverage. It appears when a last resort plan becomes a central pillar instead of a narrow backstop. It appears when the price of risk begins to reshape the geography of belonging. That is the weight of 19. Not 19 flames, 19 system shocks. 19 reminders that fire is no longer only measured in acres burned or structures lost. It is measured in whether recovery remains insurable. But the headline number is still not the real trap. The real trap is quieter. It is not the count of billion-dollar fires. It is the count of households being moved out of the ordinary insurance market, one policy at a time. The real trap is not the count of billion-dollar fires. It is the count of households being moved out of the ordinary insurance market, one policy at a time. That number is quieter than a fire perimeter. It does not appear on television as a wall of flame. It does not turn the sky orange. It does not send aircraft over a canyon or emergency alerts across a county. It arrives in a form that looks harmless until the household understands what it means. A renewal notice, a non-renewal notice, a premium that no longer fits the budget. A broker saying the standard market has narrowed, a mortgage lender asking for proof of coverage, a last resort policy that keeps the house technically insured but changes the structure of protection around the family. This is the hidden number. The visible number makes the headline. The hidden number writes the damage. The visible number is $19 billion wildfire events. The visible number is acres burned, structures destroyed, smoke plumes, evacuation zones, suppression cost, and insured losses. Those numbers matter. They are real. They are not cosmetic. They show the physical violence of fire and the economic force of catastrophe. But they still describe the event after it has become visible. The hidden number describes something earlier. It describes how many households are already losing ordinary access to coverage before the next fire arrives. It describes how many zip codes are being treated as distressed because insurance is hard to obtain. It describes how much pressure is being transferred from the standard market into the fair plan. It describes how a system designed as a backstop begins to carry more of the load. That is why this story cannot be told only from the fire line. The fire line shows what burns. The insurance line shows what may not recover. According to the California Department of Insurance, fair plan policy counts are not just internal paperwork. They are being used as a market stabilization signal. In plain language, if more people are being pushed into the fair plan, the state can read that as stress in the ordinary insurance market. If fewer people rely on it over time, the state can read that as evidence that the market is becoming healthier. That detail changes everything. It means the hidden number is not a side note, it is a diagnostic instrument. A doctor does not only look at the wound after an injury, a doctor also looks at blood pressure, oxygen levels, pulse, inflammation, and signs that the body is struggling before collapse becomes visible. The insurance market has its own vital signs. Fair plan growth is one of them. Distressed zip codes are another. Coverage availability is another. Premium pressure is another. Claims capacity is another. When those numbers move together, the system is telling a story. Not every household in the fair plan has the same reason for being there. Not every policy shift is caused by one fire. Not every premium increase can be reduced to one climate signal. Insurance markets are shaped by many forces at once, including rebuilding costs, legal costs, reinsurance prices, regulation, investment conditions, exposure growth, and company decisions. But the pattern still matters. When a last resort plan grows in a state with repeated billion-dollar wildfire events, the question becomes unavoidable. Is the safety net catching the few, or is it starting to carry the many? The difference is critical. A safety net works when it remains a backstop. It is there for difficult cases. It is there when the normal market cannot solve a household's problem. It may be more limited. It may be more expensive. It may require additional coverage from other sources, but it can still serve its purpose if the number of people depending on it stays manageable. A fault line appears when the backstop becomes central. That is the hidden risk, not that the fair plan exists. It is supposed to exist. The risk is what happens when the system needs it too much. Imagine a bridge built for emergency traffic. It is not the main highway. It is a backup route. For years, a few cars use it when the main road is blocked. Then the main road begins closing more often. More drivers are sent onto the backup route. Then trucks arrive, then school buses, then ambulances, then daily commuters. At first, the bridge still stands, so officials can say traffic is moving. But the deeper question is whether the backup route was ever designed to become the highway. That is the insurance problem in miniature. The weak point is not simply that California has fires. The weak point is that fire risk can push recovery demand into a financial structure that was not built to replace the normal market. This is not just wildfire risk. This is an insurance fault line. The hidden number changes the risk, because insurance is not only a product, it is a gate. It is a gate to a mortgage. It is a gate to rebuilding. It is a gate to household stability. It is a gate to buying or selling a home. It is a gate to whether a family can remain in a community after a disaster. If coverage is available, adequate, and affordable, a household has a bridge across catastrophe. The bridge may be imperfect. There may be delays. There may be disputes. But the bridge exists. If coverage becomes unavailable, too narrow, or too expensive, the bridge weakens before the disaster begins. That is why the hidden number reaches people who have never filed a wildfire claim. A homeowner may look out the window and see no smoke. The trees may be green after winter rains. The driveway may be clear. The house may have a new roof, cleared brush, and defensible space. The family may believe it has done what responsible people are supposed to do. Then the renewal notice arrives. The physical house has not changed overnight, but the financial environment around the house has changed. That is the part many disaster stories miss. Risk does not always arrive as an event. Sometimes it arrives as a reassessment. An insurer reassesses the area. A reinsurer reassesses the exposure. A model reassesses the possible loss. A regulator reassesses what rules are needed. A household reassesses whether it can afford to stay. The damage starts before the damage. This is not emotional exaggeration. It is how financial systems transmit hazard. Wildfire begins in fuel and wind. Insurance stress begins when that hazard is converted into expected loss. Expected loss becomes price, underwriting, availability, and policy language. Those things become household decisions. Household decisions become community outcomes. The visible fire burns across land. The hidden fire moves through access. The first people affected are often not the people whose homes burned yesterday. They are the people whose homes might burn tomorrow, or next year, or in the model, or in the risk zone. They are asked to live inside a probability that has already become expensive. That is a strange burden. A family can be punished by a disaster that has not happened to them yet, not because anyone is trying to punish them, but because the market is trying to price the possibility of future loss. That is the cold logic of insurance. It pools risk, but it also separates risk. It offers protection, but it must decide what protection costs. It spreads losses, but it also identifies places where losses may be too large or too concentrated to carry at the old price. When wildfire risk rises, insurance can become the place where the future arrives early. A fire may be seasonal, a premium is scheduled, a smoke column may appear suddenly, a renewal date is already on the calendar, a red flag warning may last days, a coverage problem can last through the entire year. That is the abnormal pattern. The climate hazard and the financial calendar are no longer moving together. Fire danger may rise in one season, but insurance pressure can arrive in any month. A family can be safe on a Tuesday and still learn on Wednesday that the market has changed around them. This is why distressed zip codes matter. A zip code is not a person, it is an administrative boundary, but once a zip code appears on a distressed area map, it carries a message. It says, insurance access is not evenly strained across the state. The problem has geography. It has streets, hillsides, valleys, rural roads, wooded neighborhoods, canyon communities, and suburban edges where fuel and housing meet. The state sees those places as more than scenery. It sees them as market pressure zones. That matters because official recognition can change policy. It can shape insurer commitments. It can guide reforms. It can help decide where companies are expected to write more coverage. It can show where consumers have fewer choices. It can make visible what households already know privately from phone calls with brokers. When people say they cannot find coverage, that is anecdote. When the state maps distressed areas, the anecdote becomes a pattern. The hidden number also changes who becomes vulnerable first. It is easy to imagine wildfire vulnerability as only the person closest to the trees. That is partly true. Physical exposure matters. A house in a high hazard zone faces real danger, but insurance vulnerability does not follow only the flame path. It can hit a retired homeowner on a fixed income. It can hit a first-time buyer whose mortgage depends on affordable coverage. It can hit a renter if the landlord's insurance cost rises and gets passed through as rent. It can hit a small business if commercial property coverage becomes harder or more expensive. It can hit a local government if property values weaken or rebuilding stalls. It can hit a family that wants to leave but discovers buyers are asking the same insurance questions. It can hit people long before evacuation. That is why the hidden number is not just a market statistic. It is a human pathway waiting to happen. A household enters the system through one small document. That document may say the insurer will not renew. It may say the premium has changed. It may say coverage is limited. It may say mitigation is required. It may say the policy is moving to a structure the family does not fully understand. The document is small. The consequences are not. A non-renewal notice can send a family into hours of phone calls. It can force them to gather quotes, compare exclusions, ask about deductibles, call the lender, recalculate the budget, and decide whether to accept coverage that feels worse than what they had before. If the FAIR plan becomes the available path, the family may still need to understand what it covers and what it does not. They may need separate coverage to fill gaps. They may need to pay more for a combination of policies that resembles what one policy used to provide. They may find that technical insurance availability does not feel like security. That is where recovery starts breaking first. Not in the dramatic moment after a house burns. In the quiet moment when protection becomes complicated. The danger is not only that a home may be destroyed, it is that the financial shelter around the home can become unstable even while the walls are still standing. This is the difference between hazard and resilience. Hazard is what can hurt you. Resilience is whether you can absorb the hit and recover. Insurance sits between those two ideas. It does not stop embers from landing on a roof. It does not clear brush. It does not build a firebreak. It does not move wind. But it can determine whether a household has money to rebuild, replace, relocate, repair, or survive a long displacement. So when insurance access weakens, resilience weakens. That is why the hidden number writes the damage. It tells us where recovery may fail before the disaster arrives. It tells us which communities are entering fire season with less financial protection. It tells us which households may be technically housed but financially exposed. It tells us how much pressure is accumulating inside the last resort system, and it tells us that the real crisis may not be measured only by what burns, but by what becomes too risky to insure in the ordinary way. This is the line the video has to follow now. From the fire to the policy, from the policy to the household, from the household to the market, from the market to the state. The next question is how that line forms in the first place. Why does a wildfire miles away from a house change the price or availability of insurance around that house? Why does a past disaster reshape a future policy? Why does a model begin to matter almost as much as a flame? To answer that, the story has to move from the visible fire into the hidden transmission system that turns fuel, wind, housing, and rebuilding cost into insurance pressure. The mechanism begins outside, but it does not end there. The mechanism begins outside the house. Not inside an insurance office, not inside a rate filing, not inside a spreadsheet. The first part of the mechanism begins in the landscape itself, where vegetation, wind, terrain, heat, drought, and housing location decide how much fire can become loss. But the mechanism does not stay outside. That is the key. Wildfire risk becomes insurance risk through transmission. It moves from fuel into flame, from flame into structures, from structures into claims, from claims into expected loss, from expected loss into models, from models into price, from price into availability, from availability into household stability. And when too many households lose ordinary access to coverage, that same risk moves into the FAIR plan. This is not just wildfire risk. This is an insurance fault line. The first layer is fuel. Fuel does not mean only tall trees. It can mean brush, grass, dry leaves, shrubs, fences, decks, sheds, wooden siding, stacked firewood, vehicles, and the small objects around a property that allow fire to move from the natural environment into the built environment. In a wildfire, the landscape and the neighborhood can become part of the same burn path. A hillside can burn, then a fence can burn, then a deck can burn, then an attic vent can draw in embers, then a home that never touched the flame front can still ignite. That detail matters for insurance because loss does not require the entire forest to burn. Loss requires enough structures to be damaged or destroyed at the same time. The second layer is wind. Wind is not just weather in this story. Wind is the delivery system. Wind pushes flame. Wind carries embers. Wind changes the speed of the event. Wind can turn a manageable ignition into a moving front. It can send burning material across a road, across a fire break, across a cleared yard, or across the distance that made a homeowner feel safe. This is why wildfire risk is not measured only by distance from trees. A house can be exposed through ember travel, a neighborhood can be exposed through wind corridors, a community can be exposed because evacuation routes, power lines, water pressure, and firefighting access are all being tested at once. The map may show fuel, but the wind decides how fast risk travels. The third layer is terrain. California's fire landscape is not flat. Canyons, ridges, slopes, foothills, and valleys shape how fire moves. A fire can climb, it can accelerate uphill, it can be channeled through terrain, it can trap roads, it can complicate response, it can make a structure physically close to help, but operationally difficult to defend. To a resident, terrain is scenery. To a firefighter, it is behavior. To an insurer, it is exposure. The fourth layer is housing. This is where the mechanism begins to change from environmental risk into financial risk. Homes are not evenly distributed across California's hazard zones. Some sit on suburban edges, some sit in canyon communities, some sit in foothill towns, some sit near brush, grassland, or forest. Some were built when wildfire was understood differently. Some have been hardened, some have not. Some communities have defensible space, road access, and water systems. Others have narrow roads, older structures, and limited evacuation options. The fire does not see a property line the way a mortgage does. It sees material that can burn. A home is not only a shelter in this mechanism, it is insured value, it is collateral, It is family wealth. It is tax base. It is rebuilding cost. It is a potential claim. That is where the market begins to pay attention. The fifth layer is concentration. One exposed house is one risk. A large number of homes exposed to the same kind of event is a concentration of risk. Insurance can absorb many individual losses spread across time and geography. That is the basic idea of pooling risk. But catastrophe changes the math because many losses can arrive together. If one house burns, one claim arrives. If one neighborhood burns, hundreds may arrive. If an urban wildfire reaches dense housing, thousands of claims can begin moving through the system at once. That is when wildfire becomes more than a hazard. It becomes an accumulation problem. An insurer has to ask not only whether one house is risky, but how many similar houses could be damaged in the same event. It has to ask whether its policyholders are too concentrated in one exposed area. It has to ask whether a single wind-driven fire could create claim volume beyond what the old assumptions expected. This is the moment when the physical map becomes a financial map. The sixth layer is reconstruction cost. A wildfire claim is not only the market value of a house before the fire. It can include the cost to rebuild under current conditions. That cost can be affected by labor shortages, material prices, building codes, debris removal, environmental cleanup, temporary living expenses, permitting, contractor availability, and the fact that many households may be trying to rebuild in the same region at the same time. A home that cost one amount to build years ago may cost much more to replace now. That difference matters. Insurance is not pricing nostalgia. It is pricing replacement. If replacement cost rises, claim severity rises. If claim severity rises across many homes, expected loss rises. If expected loss rises, insurers have to decide whether the premium, policy language, reserves, and reinsurance structure still match the risk. This is where a family's kitchen, roof, walls, garage, furniture, hotel bill, and rebuilding delay become part of a larger market calculation. The seventh layer is reinsurance. Most viewers never think about reinsurance, but it is one of the hidden pipes in the system. Insurance companies also buy insurance. They use reinsurance to help survive large events that produce many claims at once. When wildfire losses become larger, more repeated, or harder to predict, reinsurance can become more expensive or more restrictive. That cost does not stay far away. It can move into the price insurers need to charge. It can affect how much risk they are willing to write. It can affect whether they want to expand or retreat in a high-risk area. A homeowner does not receive a reinsurance contract in the mail, but the cost of that contract can still arrive in the premium. This is how a global financial system enters a California mailbox. The eighth layer is modeling. A model is not the fire. It is not proof of what will happen to one house. It is an attempt to estimate future loss across many possible events. A wildfire catastrophe model may look at terrain, vegetation, weather, ignition patterns, structures, mitigation, claims history, and many other variables. It tries to answer a question the old record alone cannot fully answer. What could happen next? That question is uncomfortable because it moves insurance away from looking only backward. Past loss still matters, but when the risk environment changes, insurers argue that the past alone may understate the future. California regulators have responded by allowing reviewed forward-looking wildfire catastrophe models to be used in rate filings under new rules, while also requiring insurers using those models to increase coverage in wildfire-prone areas. This is not a small technical change. It is part of the bargain at the center of the crisis. The state wants more availability. Insurers want permission to price future risk more fully. Homeowners want coverage they can actually afford. No part of that triangle is simple. If prices are held too low for the risk, insurers may retreat. If prices rise too fast, homeowners may be unable to stay. If availability returns but coverage is too expensive, the system may look healthier on paper than it feels in real life. That is the tension. The ninth layer is regulation. Insurance is not like buying a chair. It is a regulated market because failure affects households, banks, communities, and disaster recovery. Regulators have to balance solvency, availability, affordability, consumer protection, and market stability. In California, that balance has become especially difficult because the state has repeated billion-dollar wildfire loss, enormous housing value, high rebuilding costs, and communities already struggling with affordability. A regulator cannot simply command risk to disappear. A regulator cannot make a fire less destructive by lowering a premium. A regulator cannot protect consumers if companies leave the market entirely. But a regulator also cannot ignore households being priced out or pushed into last resort coverage. That is why the insurance department's strategy matters. It is trying to pull companies back into distressed areas, reduce dependence on the FAIR plan over time, and modernize how wildfire risk is priced and covered. But the strategy has to operate inside the same mechanism that created the pressure. Fuel still dries. Wind still moves. Homes still stand in exposed areas. Rebuilding still costs money. Reinsurance still prices catastrophe. Models still convert future loss into present decisions. The regulation does not stop the mechanism. It tries to keep the mechanism from breaking the market. The 10th layer is underwriting. Underwriting is where the broad map becomes a specific decision. An insurer looks at a home or an area and decides whether to offer coverage, at what price, under what conditions, and with what limits. That decision may include the location of the home, the surrounding vegetation, the slope, the roof, the distance to fire services, the claims environment, the company's own concentration of risk, and the overall strategy of the insurer. To the family, underwriting may feel personal. To the company, it is portfolio management. That mismatch produces anger and confusion. A homeowner may say, "My house did not burn. I cleared the brush. I installed vents. I followed the rules. Why is my coverage changing?" The market may answer, "Because your individual house sits inside a larger pattern of expected loss." That answer may be rational in a model. It may still be devastating in a kitchen. This is how the mechanism reaches the human scale. Not with flames, with a decision. The 11th layer is the renewal. A renewal is one of the most ordinary documents in household life. It arrives, people open it, they check the price, they call if something looks wrong. They file it away. Most years, it is not a life event, but in a stressed insurance market, the renewal becomes a hazard signal. It may show a premium jump, it may show reduced coverage, it may show new requirements, or it may not arrive as a renewal at all. It may arrive as a non-renewal. That is the moment the mechanism crosses the threshold. The fire risk that began in vegetation has entered the household. The mechanism begins above the property in weather and wind. It moves through the surface in fuel and terrain. It reaches the building through embers and materials. It reaches the insurer through expected loss. It reaches the household through paperwork. By the time it becomes visible to the family, the system is already carrying load. The 12th layer is the FAIR plan. When normal coverage becomes unavailable, the household may turn to the insurer of last resort. The FAIR plan can keep a property from becoming uninsured. That is important. But it does not erase the stress that pushed the household there. It may also require the household to understand a more complicated coverage structure, including what is covered, what is not covered, and what additional policies may be needed. The FAIR plan is the place where the mechanism concentrates. It receives households after the standard market narrows. It becomes more important as risk rises. It becomes a market stability signal because its growth can show that ordinary availability is under pressure. This is why the last resort plan is not just an endpoint, it is a gauge. When the gauge rises, the system is saying something. The message is not that every household will burn, the message is that ordinary risk sharing is struggling in certain places. The market is no longer absorbing wildfire risk in the same way. More of the pressure is being transferred into a public-facing backstop. That transfer is the fault line. The flame is physical, the fault line is financial. And this fault line can move even when there is no active fire. That is one of the hardest parts to understand. People expect disaster to feel immediate. Sirens, smoke, heat, evacuation orders, breaking news. But insurance risk can shift quietly. A model changes, a filing changes, a reinsurance price changes, a company strategy changes. A zip code becomes harder to write. A family receives a notice, no smoke appears, but the system has moved. This is why the mechanism is dangerous without needing exaggeration. It does not require every insurer to leave. It does not require every home to burn. It does not require a single cause to explain every decision. It only requires enough expected loss, enough uncertainty, enough concentration, and enough cost pressure to make normal coverage harder in the places most exposed. That is already enough to change behavior. Homeowners may spend money on mitigation not only to reduce fire risk, but to remain insurable. Buyers may avoid areas where coverage is uncertain. Sellers may discover that insurance questions affect demand. Local governments may worry that future development depends not only on roads and water, but on whether insurance can be obtained. Insurers may return to some areas only under new pricing rules. Regulators may measure success not only by lower premiums, but by whether people can leave the last resort market. This is a whole system mechanism. The fire is only the visible beginning. The real transmission line runs from hazard to finance, from finance to housing, from housing to community, from community to the state. And once that line is active, each new major wildfire does more than burn what is in front of it. It updates the memory of the system. It becomes evidence in the next model, the next filing, the next renewal, the next household decision. That is why $19 billion wildfire events matter. They are not only past disasters, they are inputs. They help shape how the next risk is priced. They help shape how much coverage is offered. They help shape whether the FAIR plan grows or shrinks. They help shape whether a family sees its house as secure or as a financial question mark surrounded by dry fuel. The mechanism begins in the atmosphere and the landscape, but it ends in the room where a household reads the mail. And that is where the next part of the story has to go, because a mechanism does not become real for most people when it appears in a model. It becomes real when one family realizes the fire has entered their life before anything burns. The fire enters the house before the fire reaches the house. It enters on paper. Imagine a family living in the foothills east of a California city, not deep in a forest, not isolated at the end of an old dirt road, not surrounded by flames. Their home sits on a slope where oak, brush, grass, fences, decks, and neighboring houses form the everyday landscape. From the kitchen window, the scene looks familiar. Morning light on dry hills, a road bending down toward town, a school bus route, a grocery store 20 minutes away, a fire station close enough to feel reassuring, but not close enough to make the risk disappear. The family has done what they were told to do. They cleared vegetation near the house. They cut back branches. They moved firewood away from the wall. They cleaned leaves from gutters. They replaced old vents. They talked with neighbors about defensible space. They paid the mortgage on time. They paid insurance every year. They did not file a claim. Their house did not burn. Then the letter arrives. It does not look like a disaster. There is no smoke in the room, no siren, no evacuation warning, no emergency official at the door, just an envelope from the insurance company, placed among advertisements, bills, and ordinary mail. One person opens it at the kitchen counter. The language is formal. The reason is written in the careful voice of a company that has made a decision. The policy will not be renewed, or the premium has changed enough to make the family reread the page, or new conditions have appeared, or coverage will be offered only in a structure that no longer feels like the policy they used to understand. For a few seconds, nothing happens. The house is still standing. The coffee is still warm. The refrigerator still hums. The children, if there are children, are still getting ready for school. The dog still wants to go outside. The same light is still on the hills, but the financial shelter around the home has shifted. That is how the human pathway begins. The body does not experience climate change as a graph. A household experiences wildfire risk as a letter. The first physical reaction may be small, a tightening in the chest, a pause before calling the spouse, a hand reaching for the phone, a search through old files for last year's policy, a quick calculation of monthly payments, mortgage, electricity, car insurance, water, groceries, property tax, medical bills, school costs, repairs, savings. Then comes the first call. The family calls the insurance company. The representative may be polite, the explanation may be limited, the decision may come from underwriting. The risk profile of the area has changed. The company is reducing exposure. The policy no longer fits current guidelines. The house may be fine, but the zone is difficult. The words are not cruel. That can make them harder to fight. The family calls a broker. The broker already knows the pattern. This is not the first call that week. It may not be the first call that day. The broker asks for the address, the current policy, the renewal date, the mortgage requirement, the coverage limits, the roof age, the distance to brush, the distance to fire services, the year built, the updates made, the vegetation cleared, the claims history. The family answers. They have receipts, they have photos, they have proof of mitigation. They have the feeling that responsibility should matter, and sometimes it does. Mitigation can help. A hardened home can be safer. Defensible space can matter. Local fire preparation can reduce exposure. But the family quickly learns that insurance decisions do not look only at personal effort. They also look at the surrounding area, the concentration of risk, the modeled loss, the company's total exposure, and the possibility that one wind-driven event could create many claims at once. The family is not being judged only as a household. They are being priced as part of a landscape. That is the second shock. The first shock is losing the old policy. The second shock is learning that the house is no longer only a house. It is a point inside a model. The broker begins searching. One carrier declines. Another does not write in that area. Another offers a quote that is far higher than expected. Another requires conditions the family cannot meet before the renewal deadline. Another will consider the property, but not at the coverage level the lender expects. Days start to matter. The mortgage does not wait for the family to process the news. A lender requires insurance because the home is collateral. If the family cannot provide proof of coverage, the lender may place insurance on the property. That kind of lender-placed coverage can be expensive and may protect the lender's interest more than the homeowner's full household needs. The family does not want that. They need their own policy. They need coverage that satisfies the mortgage and still protects their life inside the home. Now the risk has moved again, from landscape to insurer, from insurer to broker, from broker to lender, from lender to household budget. This is not just wildfire risk. This is an insurance fault line. The family may be directed toward the FAIR plan. The name sounds reassuring because it contains the word fair. It also sounds official, which can make it feel like a complete solution. And in one sense, it is a solution. The FAIR plan can provide access when the standard market does not. It can prevent a household from being completely uninsured. It can keep a mortgage from becoming an immediate crisis. For many families, it is the only available bridge. But a bridge can still be narrow. According to the California Department of Insurance, the FAIR plan exists for people who cannot obtain coverage in the traditional market. The department has also said that many policyholders may need separate coverage for risks that standard homeowners' policies often include, such as liability or water damage. That means the family may not simply replace one familiar policy with another familiar policy. They may have to assemble protection from pieces, one policy for fire, another policy for other household risks, different limits, different exclusions, different deductibles, different bills, different deadlines. The family has entered a more complicated version of being insured. This is where paperwork becomes emotional, but the emotion comes from facts. The family is not afraid because someone told them to panic. They are afraid because they can see the chain forming in real time. If the premium rises too much, they must cut somewhere else. If the coverage is too narrow, they may be exposed to losses they assumed were covered. If the mortgage requirement is not satisfied, the home itself becomes financially unstable. If they cannot sell because buyers face the same insurance barrier, the house becomes less liquid. If they stay, they carry the risk. If they leave, they may carry the cost. This is the human pathway. It is not a cinematic disaster sequence. It is an administrative disaster sequence. It unfolds through hold music, email attachments, scanned documents, quote comparisons, lender messages, and family conversations after dinner. One person asks whether they should move. Another asks who would buy. Someone says the kids are settled. Someone says the parents are nearby. Someone says they have put everything into this house. Someone else says the math is changing. The fire is not visible, but the decision is. That is the strange violence of insurance stress. It does not always break a window, it breaks assumptions. The family had assumed the house was a stable asset. They had assumed insurance was an annual expense, not an existential question. They had assumed that if they maintained the property and paid on time, the system around the house would remain predictable. Now predictability is gone. A home is not only walls and a roof, it is a promise about the future. People buy homes because they believe they can plan around them. They plan commutes, schools, retirement, garden beds, holiday meals, repairs, equity, family visits, and the slow accumulation of ordinary life. Insurance stress interrupts that promise. It turns the future from a path into a question. Can we stay? Can we afford this? Can we rebuild if something happens? Can we sell if we need to? Can we trust that next year will not be worse? Those questions do not stay inside one house. If enough households in one area ask them at once, the community begins to change. Buyers become cautious, sellers become nervous, local businesses hear more uncertainty. Real estate agents spend more time discussing insurance before kitchens and bedrooms. Lenders ask sharper questions. Contractors wonder whether future work will be financed. Local officials begin to understand that wildfire risk is now shaping the housing market even before the next incident. This is how the mechanism moves from one kitchen table into a town. A retired couple may decide the new premium is too much on a fixed income. A young family may decide not to buy in the neighborhood. A renter may see costs passed through by a landlord whose own insurance has risen. A small business owner may face commercial coverage problems while also depending on customers who are stressed by household bills. A teacher, a nurse, a mechanic, or a firefighter may find that living near the community they serve becomes harder. The fire risk began outside, but the social damage begins inside normal life. It is important not to exaggerate this. Not every household faces the same outcome. Some families find coverage, some insurers remain active, some mitigation helps, some reforms may improve availability, some premiums rise but remain manageable, some homeowners absorb the cost, some zip codes recover market options over time. But the warning does not require every household to fail. A system can be in trouble when enough households begin facing the same impossible calculation. That calculation is the human version of the dashboard. The state sees fair plan policy counts. The family sees a bill. The state sees distressed zip codes. The family sees fewer choices. The state sees market stabilization metrics. The family sees a deadline. The state sees the need to balance availability and pricing. The family sees whether the mortgage can close, whether savings will survive, whether retirement is still possible, whether the home remains a place of security. Both views are real, but only one view is felt in the body. The body feels the late-night search for quotes. It feels the argument at the table. It feels the loss of sleep before a renewal deadline. It feels the humiliation of asking adult children for help. It feels the frustration of having done mitigation work and still being told the area is difficult. It feels the anger of being careful and still being trapped inside a regional risk category. That is why this story has to pass through one household. Without the household, insurance sounds abstract. With the household, the entire system becomes visible. The dry grass is outside, the wind is outside, the model is inside a company, the regulation is inside a state office, the reinsurance cost is somewhere the family will never see. But all of it arrives as one question: what will it cost to remain protected here? The answer can change a life. It can change when a person retires. It can change whether a child stays in the same school. It can change whether a family repairs the roof or delays medical care. It can change whether a household uses savings meant for college, aging parents, or emergencies. It can change whether the home is still a source of security or becomes the largest uncertainty in the family's life. This is the path from climate hazard to household stress. Not because climate alone explains every insurance decision, it does not, but because wildfire risk has become one of the forces moving through the entire chain. It interacts with rebuilding cost, regulation, reinsurance, housing demand, and company strategy. By the time it reaches the family, the cause is no longer simple, but the effect is simple enough to understand. The old policy is gone, the new coverage is harder, the deadline is real. The house is still standing, but the protection around it has weakened. That is the sentence that stays. The house is still standing, but the protection around it has weakened. And when that happens across enough homes, the weak point is no longer hidden inside one envelope. It becomes concentrated inside the system that receives families when the ordinary market has no good answer. The next clue is smaller than the whole insurance market. It is the last resort plan being asked to carry more than a last resort load. The weak point is not the whole insurance market. The weak point is the last resort plan being asked to carry more than a last resort load. That is the part that can be easy to miss, because the California FAIR Plan sounds like a solution. And in one narrow sense, it is. It gives property owners a way to obtain basic fire coverage when the ordinary insurance market will not offer it. It can keep a homeowner from being completely uninsured. It can satisfy an urgent need when a lender wants proof of coverage and the renewal deadline is closing in. But a solution can also reveal the shape of a failure. A backup generator is useful during an outage. It becomes a warning sign when the hospital depends on it every week. An emergency lane is useful during a crash. It becomes a warning sign when daily traffic has to use it to keep the city moving. A last resort insurance plan is useful when a small number of households cannot find ordinary coverage. It becomes a warning sign when the market needs it as a central pillar. That is the California fault line. The FAIR plan is not the fire, it is not the wind, it is not the dry fuel, it is not the canyon, the slope, the ember, or the burning roof. But it is where all of those risks arrive after they have been converted into insurance pressure. It is where the ordinary market sends households when the ordinary market has no workable answer. The weak point is not that the FAIR plan exists. The weak point is what happens when too much risk concentrates there. To understand that, imagine how the system is supposed to work during normal conditions. A homeowner looks for coverage. Several insurers compete for that household. They evaluate the property. They price the risk. The homeowner may choose between carriers, coverage levels, deductibles, and service reputations. The market is not perfect, but there are options. Risk is spread among private companies. No single backstop has to carry a large share of the hardest exposures. In that version of the system, the FAIR plan sits behind the market. It catches the people who fall through. Now change the conditions. Wildfire losses become larger. Rebuilding costs rise. Reinsurance grows more expensive. Models show higher possible losses in fire-exposed zones. Insurers become more cautious about where they write policies. Some stop writing new business in certain areas. Some reduce exposure, some non-renew. Some raise prices where allowed. Some require mitigation. Some wait for regulatory changes before expanding again. The homeowner still needs coverage. The mortgage still requires proof. The house still has to be insured. So the household moves toward the backstop. One family can do that, then another, then another. Then an entire set of communities begins hearing the same sentence from brokers. The FAIR plan may be the option. That is how a backstop becomes a pressure vessel. The pressure does not come from one household. It comes from concentration. A last resort plan that receives more high-risk properties may also receive a larger share of future claim exposure. If a major wildfire hits the same geography where many FAIR plan policies are concentrated, the plan is not dealing with one difficult case. It is dealing with accumulated risk. That is why the number of policies matters. A policy count is not just administration, it is stored exposure. Each policy represents a home, a business, a building, a household budget, a lender requirement, and a possible claim after the next disaster. When that count rises in high-risk territory, the system is not merely getting busier, it is becoming more exposed at the exact point designed as the fallback. The weak point is not the whole system. The weak point is the place where the fallback becomes the main path. This is not just wildfire risk. This is an insurance fault line. The state insurance department has described FAIR plan policy growth as a market stability signal. That phrase is technical, but the meaning is direct. If more people are entering the last resort system, something is wrong upstream. If fewer people depend on it over time, that may suggest the ordinary market is recovering. The FAIR plan is therefore not only a provider, it is also a gauge, and gauges matter most before failure becomes obvious. A rising temperature gauge does not mean the engine has already died. It means the system is heating under load. A rising flood gauge does not mean the levee has already broken. It means pressure is building. A rising last resort insurance count does not mean every household is uninsured. It means ordinary access is under strain. That is why this gauge deserves attention. The FAIR plan has to do several things at once. It has to provide coverage to people who cannot obtain it elsewhere. It has to process applications. It has to handle claims after disasters. It has to maintain enough financial capacity to pay those claims. It has to communicate clearly with policyholders who may not fully understand the difference between last resort coverage and standard homeowners coverage. It has to operate in a political environment where every premium, every denial, every delay, and every coverage gap can become a public crisis. It has to stand between households and the complete collapse of insurability in some places. That is a heavy job for a backstop, and the load does not arrive evenly. A calm year may make the system look manageable. Applications arrive, policies are written, premiums are collected, the paperwork continues. Officials discuss reform, insurers negotiate rules, households adapt, however painfully. Then a major fire arrives. Suddenly the question changes. How many claims arrive at once? How complicated are they? How much smoke damage is disputed? How many homes are total losses? How many policyholders need temporary housing? How fast can adjusters reach the area? How quickly can payments move? How many families understand what their policy actually covers? How much cash must the system produce before recovery freezes? This is where the weak point becomes visible, not at the moment the policy is issued, at the moment the policy is tested. Insurance is a promise about the future. The promise is not proven when the premium is paid. It is proven when the loss happens, and the household needs the policy to become money, repairs, housing, and time. If that conversion is slow, recovery slows. If that conversion is disputed, recovery becomes legal and administrative. If that conversion is incomplete, households discover that being insured does not always mean being made whole. If that conversion is happening across thousands of claims, the entire recovery system feels the drag. A last resort plan can keep a property insured before the fire, but after the fire, it has to become a recovery machine. That is a different challenge. Think about one damaged neighborhood. The flames pass. The evacuation order lifts for some areas. Roads reopen. Residents return. Some homes are gone. Some are damaged. Some are standing but filled with smoke residue, ash, water damage, or contamination. People need answers quickly because life does not pause for insurance review. Where will they sleep? Can they pay the mortgage while displaced? Can they begin debris removal? Can they hire a contractor? Can they replace medicine, clothing, tools, documents, and furniture? Can they afford rent somewhere else while still paying for the damaged house? Can they tell their children when they are going home? The claim is not paperwork to the family. The claim is oxygen. If claim handling slows, the delay enters the body. It becomes sleeplessness. It becomes arguments. It becomes missed work. It becomes credit card debt. It becomes relatives taking people in. It becomes families waiting in motels. It becomes elderly residents trying to understand forms while grieving the loss of everything familiar. The fire may have been the emergency. The claim becomes the recovery route. That is why the last resort plan cannot be judged only by whether it offers a policy. It has to be judged by whether it can carry people through the aftermath. The state has recognized this pressure. Officials have pushed for reforms aimed at modernizing the FAIR plan, improving claims handling, increasing transparency, strengthening staffing, improving planning, and making sure the plan has the capital and liquidity to function under stress. Those words sound administrative, but each one points to a weak point. Staffing means whether there are enough people to answer the phone and process claims. Transparency means whether policyholders understand what is happening. Liquidity means whether money can move when loss arrives. Planning means whether the system has rehearsed the scale of disaster it may face. Coverage modernization means whether the product matches the reality households think they are buying. Without those pieces, the last resort can become a maze, and a maze is dangerous during recovery. A family does not have endless time to solve coverage confusion. A contractor will not wait forever. A landlord will not hold a rental without payment. A lender will not ignore missed obligations indefinitely. A school year does not stop. A job does not pause. A local government cannot rebuild tax base with unresolved claims. This is how a small component affects the whole machine. The component is not glamorous. It is not a fire engine. It is not an aircraft. It is not a reservoir. It is not a power line. It is a policy system. But if the policy system weakens, the visible recovery slows everywhere else. A burned home cannot be rebuilt without financing. Financing depends on insurance. Insurance depends on claim payment. Claim payment depends on coverage, documentation, staffing, and solvency. Solvency depends on premiums, reserves, reinsurance, and assessments. Assessments or costs can move through the broader insurance system. The broader system can affect premiums. Premiums can affect affordability. Affordability can affect whether people stay. This is the chain. The weak point is small only on paper. In real life, it touches the entire recovery architecture. That is why the phrase insurer of last resort should sound less comforting than it does. Last resort means the system has already tried other routes. Last resort means the household did not arrive there because it wanted complexity. Last resort means the normal market did not give that household an acceptable path. A last resort is necessary, but necessity is not the same as resilience. A community is more resilient when households have multiple stable coverage options before disaster, clear policy language during disaster, and fast claim conversion after disaster. A community is less resilient when households must depend on a narrowed backstop that is itself under stress. The danger is not that the backstop fails tomorrow. The danger is that more and more recovery depends on a part of the system never meant to become the main road. That is the fault line. It is easy to imagine system failure as a sudden collapse. One day everything works, the next day everything breaks. But insurance stress usually moves differently. It moves by narrowing. A carrier stops writing, a quote disappears, a premium rises, a deductible changes, a policy becomes harder to understand. A household moves to the fair plan, a claim takes longer, a coverage dispute begins, a family waits. The collapse is not always a single moment. Sometimes the system fails by making survival more complicated year after year. That is why the fair plan is the right weak point for this story. It is where the private market retreat becomes visible. It is where household vulnerability collects. It is where official reform has to focus. It is where the state can see whether its strategy is working. And it is where the next major wildfire can test not only buildings, but the financial bridge beneath recovery. The weak point is not the flame. The weak point is the bridge after the flame. A fire can expose dry brush. A claim surge can expose dry capacity. A wind-driven event can reveal where homes were vulnerable. A last resort crisis can reveal where recovery itself was vulnerable. That is the deeper warning. California can reduce fuel, harden homes, improve evacuation, expand mitigation, and modernize insurance rules. All of that matters. But if the place receiving the most difficult insurance risk becomes overloaded, then even successful firefighting cannot solve the recovery problem. Containing the fire is not the same as containing the financial aftermath. This is why the next historical clue matters. The weak point is not theoretical. A version of this mechanism has already appeared after a major urban wildfire disaster, where the flames were only the beginning and the claim system became part of the damage field. History has already shown what happens when the last resort bridge is tested by the weight of a real disaster. This is not speculation. A version of this mechanism has already left evidence behind. It appeared in Los Angeles after the fires of January 2025, when the disaster did not end at the edge of the burn scar. The flames moved first, then the claims moved, then the disputes moved, then the delay moved, and for many survivors, the emergency changed form without ending. At first, the disaster looked like what people expect a wildfire disaster to look like: smoke over neighborhoods, evacuation orders, burned streets, people searching for names, pets, documents, medication, photographs, cars, tools, passports, birth certificates, and the small proof that ordinary life had existed there before the fire. There were destroyed homes. There were damaged homes. There were standing homes that still smelled of smoke. There were neighborhoods where the question was not only whether a structure remained upright, but what had entered it: ash, soot, chemicals, water, broken glass, toxic residue, microscopic contamination. Everything that a wildfire can carry after it moves through modern buildings, vehicles, plastics, wiring, paint, insulation, furniture, and household materials. The fire was visible. The next crisis was harder to see. It entered the claim system. According to the California Department of Insurance, the Los Angeles fires became the largest urban wildfire disaster in California history. The department later reported that insurance companies had distributed more than $22 billion in claims connected to those fires since January 2025. That number matters because it shows the scale of money moving into recovery. It also shows the scale of pressure placed on the machinery that had to convert loss into payment. A claim is not just a file. A claim is a family asking the system to turn destruction into shelter, repairs, rent, debris removal, rebuilding, replacement, and enough time to survive the gap between the old life and the next one. When that machinery works, it is almost invisible. Money moves, adjusters inspect, coverage is explained, temporary housing is paid, damage is documented, rebuilding begins. A household remains wounded, but it has a bridge. When that machinery slows, the wound stays open. That is what makes Los Angeles a precedent for the insurance fault line. The fires did not only test houses, they tested the recovery bridge underneath those houses. The California Department of Insurance later described systemic problems after the Los Angeles fires, including delays, denials, inconsistent claim decisions, and disputes over smoke damage. Those words sound bureaucratic until you put them inside a living room. Delay means a family is still waiting. Denial means a family has to fight. Inconsistent decision means one household may be treated differently from another, even when the damage feels similar. Smoke damage dispute means a home can be standing and still become a battlefield over what counts as physical loss. That last point is crucial. A burned house is easier for the system to recognize. It is gone. The photograph is clear. The loss is visible. The question becomes how much is owed, how fast it can be paid, and what coverage applies. A smoke-damaged house is more complicated. The walls may still stand. The windows may still be there. The front door may still open. From the street, the house may appear saved. But inside, the family may smell contamination. They may worry about children breathing residue. They may see soot in vents. They may wonder what chemicals settled into carpets, furniture, clothing, insulation, and air systems. They may ask whether cleaning is enough, whether testing is needed, whether remediation is covered, and who gets to decide. This is where disaster becomes technical. And technical disaster can be brutal. The family is not only arguing about money, they are arguing about whether the place they sleep is safe. The fire ended on the map before it ended in the claims system. That sentence is the lesson. In Los Angeles, the mechanism moved the way this whole story has been moving. It began with hazard. It moved through structures. It moved into insurance contracts. It moved into claim interpretation. It moved into household decisions. It moved into courtrooms, enforcement actions, legislation, and public anger. The flames created the first damage field. The claims process created the second. And the second damage field can last longer than the first. A burned neighborhood eventually cools. Debris is eventually removed. The air eventually clears. Roadblocks eventually come down. But an unresolved claim can keep a family suspended. A coverage dispute can freeze rebuilding. A low payment can force people to borrow. A denial can send survivors into months of appeals. A missing document can slow everything. A confusing adjuster process can make a household relive the disaster through paperwork over and over again. This is why the weak point from the last section matters. The last resort plan is not only judged before a disaster when it issues coverage, it is judged after disaster when policyholders need coverage to become recovery. In February 2025, the FAIR Plan asked California regulators to approve a $1 billion assessment on member insurers to help ensure covered claims from the Southern California fires could be paid. That request was an operational signal. It did not mean every claim would fail. It did not mean the system had collapsed, but it showed that the backstop was carrying a level of load large enough to require additional funding mechanisms. That is what a pressure vessel looks like from the outside. The plan still exists. The claims are still being handled. The machinery is still moving, but the pressure is visible. A household does not experience that pressure as a financial mechanism. A household experiences it as uncertainty. Will the check arrive? Will smoke damage be covered? Will the adjuster call back? Will the temporary rental be paid? Will the lender understand the delay? Will the contractor hold the estimate? Will the children be able to return to the same school? Will the family have to move twice? Will the home ever feel safe again? These are recovery questions, but they become insurance questions. Los Angeles showed that an urban wildfire can turn claim handling into a central part of disaster management. In a remote fire with fewer structures, the insured loss may still be severe. But in an urban or suburban fire, the number of damaged structures, standing contaminated homes, displaced households, renters, landlords, businesses, roads, utilities, schools, and medical needs can multiply the complexity. A wildfire in dense housing does not only burn property, it produces paperwork at urban scale. Every address becomes a question. Every policy becomes a gate. Every coverage clause becomes a possible delay. Every adjuster becomes part of the recovery infrastructure. Every disagreement can hold a family in place. That is the precedent. The Los Angeles fires exposed how disaster recovery can bottleneck after the visible emergency passes. A bottleneck is not the same as total failure. It means the flow is too narrow for the load. Claims may still move, but not fast enough for everyone. Money may still be distributed, but not without friction. Officials may still intervene, but intervention itself shows that the ordinary pathway was not enough. The bottleneck has human consequences. A survivor may be living in a temporary rental, while still paying costs tied to the damaged home. Another may be sleeping with relatives. Another may be trying to document smoke contamination while also working full-time. Another may be waiting for an adjuster to return. Another may be told the damage is not covered in the way they believed. Another may be too exhausted to fight, even when the claim matters to everything that comes next. This is how an insurance dispute becomes a health issue. Stress accumulates, sleep disappears, blood pressure rises, medication routines are disrupted. Children overhear conversations about money and moving. Older residents lose the familiar spaces that kept them oriented. Families stop thinking in months and start thinking in deadlines. The body does not experience wildfire recovery as a policy debate. It experiences recovery as waiting, and waiting can become damage. Los Angeles also revealed why smoke is such a dangerous part of the insurance fault line. Fire is dramatic. Smoke is ambiguous. Fire leaves ruins. Smoke leaves questions. Fire produces obvious loss. Smoke can produce contamination that is harder to see, harder to test, harder to price, harder to prove, and harder to resolve. That ambiguity becomes a battleground. If a policyholder says the home is contaminated, the insurer may ask what the policy covers. If the insurer says cleaning is enough, the family may ask whether the home is truly safe. If testing is disputed, the claim can slow. If the policy language is contested, the dispute can widen beyond one house. If regulators step in, the issue becomes evidence that disaster recovery is not only about rebuilding walls, but about defining what damage means after a modern wildfire. That is why Los Angeles cannot be treated as a local story only. It is a preview of the kind of recovery problem that can appear wherever wildfire meets dense housing and strained insurance systems. The similarities to the broader California crisis are clear. The same chain appears. Hazard becomes loss. Loss becomes claim volume. Claim volume tests staffing. Staffing affects communication. Communication affects trust. Trust affects whether people believe the system will be there after the next fire. The same hidden number appears. Not only acres burned, not only structures lost, but how many claims are delayed, how many households are displaced, how many policyholders dispute smoke damage, how many people are covered through last resort arrangements. How much money must move before recovery can start? The differences are also important. Los Angeles was not every California wildfire. It was an urban wildfire disaster, with dense exposure and enormous public attention. It had its own geography, weather, ignition conditions, housing patterns, legal context, and claims environment. It should not be used to say every future fire will follow the same path exactly, but a precedent does not have to repeat perfectly to matter. It only has to reveal a mechanism, and Los Angeles revealed one. A fire can move faster than the systems built to recover from it. The physical disaster can end before the administrative disaster ends. A last resort plan can be vital and strained at the same time. Insurance can protect people and still become a bottleneck. A house can survive the flame and still be trapped inside the aftermath. That is why history is not being used here as a threat. It is being used as evidence. The warning does not say Los Angeles will happen everywhere. The warning says the mechanism that appeared there is real. It has already moved through households. It has already forced regulators to respond. It has already shown that smoke damage, claim speed, policy language, and last resort capacity are not side issues. They are part of the disaster itself. This is the part the old wildfire story could not hold. The old story ended when the perimeter was contained. The new story keeps following the claim, because if the claim does not move, the family does not move. If the family does not move, the neighborhood does not recover. If the neighborhood does not recover, the local economy does not fully recover. If enough neighborhoods face that pattern, the insurance problem becomes a recovery problem for the state. This is not just wildfire risk. This is an insurance fault line. Los Angeles showed the fault line under load. It showed that the last resort bridge can be tested not only by the number of policies it carries before disaster, but by the number of promises it must fulfill after disaster. It showed that official payouts can be enormous, while individual households still feel stuck. It showed that total dollars paid and recovery quality are related, but not the same thing. A system can distribute billions and still leave people fighting. That is the uncomfortable lesson. Scale alone does not prove the recovery machine is working for every household. It proves the machine is large. To know whether it is working, you have to look at speed, clarity, fairness, coverage, communication, and whether people can actually return. That is the evidence Los Angeles leaves behind, not a prophecy, a warning light. The precedent is not saying the next fire will look identical. It is saying the next major fire will arrive in a state where insurance is already central to disaster recovery, where the FAIR plan is already a market stability gauge, where smoke damage can become a legal and financial battleground, and where households may discover that the hardest part of surviving fire is surviving what comes after. The fire goes out, the policy remains, the claim remains, the mortgage remains, the question of return remains, and once that becomes clear, the story has to expand beyond one disaster, one neighborhood, or one plan. It becomes a pattern in time, a new calendar, a recovery schedule that may no longer match the seasons California built around. The next failure is not only a fire season failure, it is a recovery calendar failure. The next failure is not only a fire season failure, it is a recovery calendar failure. That is the larger pattern California is entering. The state is not simply facing a landscape where fires can become larger, faster, more expensive, or more destructive. It is facing a calendar where the systems built around fire no longer line up with the timing of risk. The old calendar was easier to imagine. Prepare before fire season, watch the weather during fire season, evacuate during the emergency, contain the fire, file the claim, rebuild afterward. That sequence was never simple. It was never painless. It was never equally fair for every household, but it had a recognizable order. Danger came, then response came, then recovery came. Now the order is breaking. Insurance pressure can arrive before the smoke. A non-renewal can arrive months before the red flag warning. A reinsurance decision can be made on a global financial calendar before a California family even knows its premium will change. A rate filing can shape future availability before the next ignition. A buyer can lose confidence in a house before any flame touches the neighborhood. A household can enter the FAIR plan during a week when the sky is blue. This is not only a wildfire problem, it is a recovery calendar failure. The first calendar is the fire calendar. California has always had fire weather, but the public imagination often compresses it into a season. Dry months, hot afternoons, winds, warnings, fire crews staged, evacuations possible, then, eventually, rain. The calendar made danger feel bounded. Even when the danger was severe, people could imagine preparation as a phase and recovery as a later phase. But wildfire risk now behaves less like a discrete season and more like a pressure that can build across the year. Vegetation grows after wet periods. Then heat and dryness cure that vegetation into fuel. Wind events arrive on their own schedule. Drought history can remain embedded in trees and brush. Dead fuel can wait. Housing exposure does not take a season off. The buildings remain, the roads remain, the power lines remain, the people remain. The second calendar is the insurance calendar. This calendar has its own rhythm, renewal dates, rate filings, regulatory reviews, company underwriting decisions, reinsurance renewals, legislative sessions, deadlines for mitigation, documentation, mortgage closing dates, premium due dates, claim payment timelines, appeal windows, temporary housing limits. The insurance calendar does not wait for flames. That mismatch is where the fault line widens. A family can be in the wrong part of the insurance calendar even when it is in a quiet part of the fire calendar. No smoke, no evacuation, no breaking news. But the renewal deadline is 30 days away, and the old carrier is leaving, and the broker has only one realistic option, and the lender needs proof, and the premium is no longer a line item. It is a decision about staying. The third calendar is the rebuilding calendar. After a destructive fire, rebuilding is not immediate. It moves through debris removal, damage assessment, insurance adjustment, permitting, design, financing, contractor availability, inspections, code requirements, utility restoration, and personal capacity. The family has to make decisions while exhausted. The town has to make decisions while damaged. Contractors are limited. Materials cost money. Public agencies have backlogs. Schools and employers do not pause indefinitely. Recovery has a tempo. If insurance money arrives quickly, the tempo changes one way. If claims are delayed or disputed, the tempo changes another way. If coverage is incomplete, the tempo slows. If temporary housing support runs out before rebuilding begins, the tempo breaks. A wildfire can be contained in weeks. Rebuilding can take years. That gap is not just inconvenience, It is where displacement becomes permanent for some households. The fourth calendar is the regulatory calendar. California regulators are trying to change the system while the system is already under stress. According to the California Department of Insurance, the sustainable insurance strategy is designed to restore options for consumers, reduce reliance on the FAIR plan over time, and require insurers using forward-looking catastrophe models to write more coverage in wildfire-distressed areas. That is a major shift, but regulatory repair has its own speed. Rules must be written, models must be reviewed, insurers must file rates, the state must evaluate them, consumer protections must be balanced with market availability. Companies must decide whether the new rules are enough to re-enter areas where they had reduced exposure. Households must wait to see whether any of that becomes an actual policy they can buy. The fire does not wait for the rulemaking calendar. The renewal notice does not wait either. This is the problem with system change during crisis. The old structure is already strained, but the new structure takes time to become real. In that gap, households live inside uncertainty. The fifth calendar is the household calendar. This is the one that matters most because it is the one people feel. A household does not live inside a policy white paper. It lives inside paydays, rent checks, mortgage payments, school years, medical appointments, aging parents, job schedules, tax bills, repair needs, savings goals, and ordinary fatigue. A premium increase does not arrive in a vacuum. It arrives next to everything else. If the insurance bill rises in the same year as property tax, healthcare, food, energy, and car costs, the family does not experience each system separately. It experiences one budget under load. If the renewal deadline arrives during a school term, a family may not have the emotional room to consider moving. If a claim delay overlaps with a job loss, the disaster becomes economic. If a rebuilding delay overlaps with an elderly parent's health decline, the disaster becomes medical and logistical. If insurance uncertainty overlaps with a planned home sale, the disaster becomes a market question. This is what system risk means in real life. It is not one large event. It is multiple calendars arriving at the same household at once. The sixth calendar is the community calendar. A town has its own time, school enrollment cycles, small business revenue seasons, local government budgets, fire district funding, housing turnover, road maintenance, water planning, tourism seasons, election cycles, construction windows, grant deadlines, public meetings. When wildfire and insurance pressure enter that calendar, the community can start to lose rhythm. If families delay rebuilding, school enrollment may drop. If school enrollment drops, funding can suffer. If residents leave, local businesses lose customers. If businesses close, the town loses services. If property values weaken, local tax revenue can be affected. If insurance questions make buyers hesitate, housing turnover slows. If contractors are overwhelmed, recovery stretches. If public budgets are already tight, mitigation and infrastructure work become harder. A fire can burn a neighborhood. Insurance stress can thin the future of a town. That is the larger system pattern. The danger is not only the next flame front. It is what happens when recovery takes longer than the interval between shocks. A system can handle a major load if it has time to repair. A body can recover from illness if it has rest. A road can be repaired after a storm if the next storm does not destroy the work before it is finished. A family can rebuild savings after one emergency if another emergency does not arrive too soon. But when the next load arrives before recovery is complete, resilience erodes. That is the new baseline question for California. Is the state still operating on a recovery calendar built for the past? The past assumed that private insurance could broadly carry the financial bridge. The past assumed that catastrophic wildfire was severe but not so repeated that it would reshape availability across hundreds of zip codes. The past assumed that the last resort plan could remain a backstop. The past assumed that a fire season could be separated from the insurance market season. The past assumed that if a house did not burn, the household's financial shelter would likely remain stable. Those assumptions are now being tested. Not all of them have failed everywhere. That matters. Some communities still have options. Some households still find coverage. Some mitigation works. Some insurers are still writing. Some reforms may reduce pressure. Some fair plan growth may slow. Some areas may see improvement if the standard market returns. But the direction of the stress is clear enough to study. Wildfire is no longer only an emergency management problem. It is now a housing finance problem, It is a consumer protection problem. It is a land use problem. It is a reinsurance problem. It is a public budget problem. It is a household stability problem. And because all of those systems are connected, the old separation between climate risk and financial risk no longer holds. A fire-exposed house is not just exposed to fire. It is exposed to repricing. It is exposed to non-renewal. It is exposed to lender concern. It is exposed to buyer hesitation. It is exposed to claim complexity. It is exposed to rebuilding delays. It is exposed to the possibility that staying insured becomes as important as staying physically safe. That is why the insurance retreat matters so much. Retreat does not always mean a company vanishes completely. It can mean narrower underwriting. It can mean fewer new policies. It can mean more conditions. It can mean higher prices. It can mean reduced appetite for certain geographies. It can mean more homeowners pushed to a backstop. It can mean the ordinary market still exists statewide, but becomes harder to access in exactly the places most likely to need it. That pattern is dangerous because it is uneven. A statewide average can hide a local crisis. A city may be fine while a hillside community struggles. A coastal market may look different from a foothill market. A dense urban neighborhood may have different exposure from a canyon road. A household with high income may absorb a premium that forces another family to leave. This is how climate risk becomes inequality without needing a dramatic speech. The same hazard does not land on every household with the same weight. A wealthy homeowner may pay more, harden the house, buy supplemental coverage, and stay. A middle-income family may cut savings, delay repairs, and stay under pressure. A retired couple may leave. A renter may pay indirectly through rent. A first-time buyer may never enter the market. A small town may lose the people it needs to function. The fire map may show hazard. The insurance map shows who can afford resilience. That is the uncomfortable system pattern. Resilience is not just having a fire break or a hardened roof. It is having the financial capacity to act before and after the event. It is being able to afford mitigation. It is being able to afford coverage. It is being able to wait through a claim. It is being able to rent somewhere else. It is being able to rebuild without falling out of the community. When insurance becomes harder, resilience becomes more expensive. That does not mean risk should be hidden. Accurate risk pricing matters. If risk is underpriced, insurers can become unstable, and a broken insurer helps no one after a disaster. But if risk is priced in a way households cannot survive, then the market may become technically honest and socially destructive at the same time. That is the central tension. California needs insurance prices that reflect reality. California also needs communities that can live through reality. Those two needs can collide. The state's reforms are trying to manage that collision. Allow more forward-looking wildfire models, but require insurers to write more coverage in distressed areas. Reduce reliance on the FAIR plan, but also strengthen the FAIR plan while it remains necessary. Encourage mitigation, but make sure discounts and availability reach actual households. Modernize claims and coverage, but do it after survivors have already shown where the system hurt them. This is a system attempting to redesign itself while under load. That is not impossible, but it is unstable because the load keeps changing. The next wet winter can grow fuel. The next hot summer can dry it. The next wind event can move it. The next fire can update the models. The next claims wave can expose the backstop. The next reinsurance cycle can raise costs. The next renewal season can send thousands of families back into the same search. That is why the future risk will not arrive only as a fire. It will arrive as a calendar. A month when reinsurance costs change. A month when rate filings are approved. A month when policies renew. A month when a mitigation grant opens. A month when a family has to decide whether to keep a house. A month when a claim deadline expires. A month when temporary housing support runs out. A month when the next wind event arrives before the last town has rebuilt. This is the new shape of disaster. It does not have one date, it has overlapping deadlines. The old preparedness message told households to make a go bag, clear defensible space, sign up for alerts, and know the evacuation route. Those actions still matter. They can save lives. They can reduce losses. They should not be dismissed. But the new preparedness question is wider. Can the household remain insured? Does the policy cover what the family thinks it covers? What happens if smoke damages a standing home? What happens if the mortgage lender rejects the coverage? What happens if the FAIR plan is the only route? What happens if rebuilding costs exceed limits? What happens if the next renewal arrives before the family has recovered financially from the last one. That is not fear-mongering. That is operational preparedness for a changed system. A state built around old assumptions may still have strong institutions. California has regulators, firefighters, scientists, local governments, emergency managers, insurers, advocates, and communities working the problem. The point is not that the state is helpless. The point is that the risk has expanded beyond the old frame. The fire does not only test defensible space, it tests insurance availability, it tests claims handling, it tests household savings, it tests mortgage rules, it tests local budgets, it tests whether a community can keep enough people in place to recover, and it tests whether reforms can move faster than retreat. That last test may be the most important. If the ordinary market returns to distressed areas in a meaningful way, if the FAIR plan shrinks over time, if mitigation becomes recognized and affordable, if claims handling improves, and if households regain real choices, the fault line may stabilize. But stabilization is not the same as safety. It only means the system may have slowed before the next load arrives. That is the future echo of the dashboard where this story began. The numbers were not dramatic because they were loud. They were dramatic because they showed pressure moving through the state before the next major fire. FAIR plan policies, distressed zip codes, billion-dollar wildfire history, homeowner policies still outside the backstop, regulatory reforms trying to pull the system back toward ordinary coverage. Together, those signals describe a state negotiating with time to reduce fuel, time to harden homes, time to change insurance rules, time to bring carriers back, time to process claims, time to rebuild trust, time to help households stay, time to recover before the next event rewrites the assumptions again. The future will not be decided only by the peak flame, the largest smoke plume, or the number of acres burned. It will be decided by whether the recovery system still has time to reset before the next load arrives. But before ending there, one boundary has to be drawn clearly. Not everything that happens in the insurance market can be blamed on one fire, one model, one law, or one cause. The warning is real, but it needs precision. The evidence is strong enough without turning it into a prophecy. The evidence is strong enough without turning it into a prophecy. That is where the final line has to be drawn. The warning does not need exaggeration. The evidence is already enough. According to NOAA's National Centers for Environmental Information, California has been affected by $19 billion wildfire events from 1980 through 2024. That does not mean every future fire will become a billion-dollar disaster. It does not mean every hillside will burn. It does not mean every household in a fire-exposed area will lose coverage. But it does prove that billion-dollar wildfire loss is not an imaginary category in California. It has happened repeatedly. It has entered the disaster record. It has become part of the data that institutions cannot ignore. According to the California Department of Insurance, FAIR plan policy counts are now treated as a market stability signal. That does not mean every FAIR plan policyholder is in the same situation. It does not mean every person using the FAIR plan has been abandoned in the same way. It does not mean the FAIR plan is failing just because people need it, but it does mean reliance on the last resort plan tells the state something important about the ordinary market. When that reliance grows, the system is showing stress. When that reliance falls over time, the system may be moving toward recovery. According to the same state insurance department, distressed areas are places where insurance access is difficult enough to become part of official market strategy. That does not mean every distressed zip code is uninsurable. It does not mean every property inside one of those zip codes carries the same level of risk. It does not mean no insurer will write there. But it does mean the problem has geography. It has a map. It is not only rumor, it is not only frustration from a few households. It has become visible inside the state's own system. And after the Los Angeles fires of January 2025, state officials described systemic problems involving delays, denials, inconsistent claim decisions, and disputes over smoke damage. That does not mean every claim was mishandled. It does not mean every insurer acted the same way. It does not mean every dispute proves bad faith. But it does show that wildfire recovery can bottleneck inside the claims process after the flames are gone. That is the evidence line. Wildfire history is real. Insurance market stress is real. Last resort pressure is real. Claims bottlenecks are real. Smoke damage disputes are real. Household recovery risk is real. But the causes are not simple. It would be false to say that every insurance problem in California is caused by one wildfire. It would be false to say that every premium increase is caused only by climate change. It would be false to say that every insurer leaving or limiting coverage is doing so for one reason. It would be false to say that regulation alone created the crisis, or that regulation alone can solve it. It would be false to say that a single model, a single company, a single law, or a single season explains the whole market. The truth is harder. Wildfire risk is interacting with rebuilding costs. Rebuilding costs are interacting with inflation, labor shortages, materials, code requirements, and debris removal. Insurers are interacting with reinsurers. Reinsurers are interacting with global catastrophe losses. Regulators are interacting with consumer affordability and insurer solvency. Homeowners are interacting with mortgage requirements. Local governments are interacting with tax bases, evacuation planning, and rebuilding timelines. No one part explains everything, but the parts are connected. That is what makes it a system. A fire does not have to be the only cause to be a major driver. A market does not have to collapse to be under stress. A last resort plan does not have to fail to become a warning gauge. A household does not have to lose the house to lose the feeling that the house is secure. That is the difference between exaggeration and analysis. Exaggeration says the worst outcome is certain. Analysis says the load is visible. Exaggeration says one number explains everything. Analysis follows the chain. Exaggeration turns a warning into a prophecy. Analysis keeps the boundary clear and still refuses to look away. So the final question is not whether California will burn again. A state with fire, adapted landscapes, wind, heat, dry fuel, and housing in exposed areas will keep facing wildfire. The sharper question is whether the systems around the fire can keep recovering at the speed the risk now demands. Can insurance availability return in distressed areas before more households give up on ordinary coverage? Can the FAIR plan remain a backstop instead of becoming the main road for fire-exposed communities? Can claims be handled clearly enough that survivors do not lose months fighting over what the policy means? Can smoke damage be defined, tested, and resolved in a way that matches the reality of modern wildfire contamination? Can homeowners afford mitigation before a disaster and coverage after it? Can regulators balance accurate pricing with the social need for people to remain housed? Can a town recover before the next event arrives? These are not abstract questions. They determine whether recovery is a bridge or a bottleneck. Now return to the first image. At the start, the signal was not a flame, it was an official dashboard. A policy count, a distressed zip code map, a billion-dollar disaster record, a last resort plan being watched as a market stability gauge. That image matters because it changes when the disaster begins. In the old story, the disaster begins when the fire starts. In this story, the disaster can begin when coverage disappears. In the old story, the most important map is the burn perimeter. In this story, the insurance map may reveal where recovery is already fragile. In the old story, a household is safe if the house is standing. In this story, a house can be standing while the financial shelter around it weakens. In the old story, containment feels like the end. In this story, containment is only the moment when the next system takes over. The claim system, the mortgage system, the rebuilding system, the rental market, the school district, the local budget, the family budget, the emotional system inside a household trying to decide whether home still means stability. That is why the phrase insurance fault line matters. A fault line is not always visible from the surface. People can live above it for years, roads can cross it, houses can be built over it, daily life can continue. Then, pressure accumulates. The ground does not need to open everywhere at once to reveal that the structure was vulnerable, it only has to move enough in the wrong place. California's wildfire insurance fault line is like that. It runs beneath policy renewals, it runs beneath mortgage approvals, it runs beneath rebuilding estimates. It runs beneath small towns that depend on residents returning. It runs beneath households that thought insurance was a routine bill, not a test of whether they could remain in place. And like a geological fault line, the danger is not only the rupture, it is the accumulation of pressure before the rupture. The FAIR plan count is pressure, distressed zip codes are pressure, repeated billion-dollar wildfire events are pressure, rebuilding costs are pressure, reinsurance costs are pressure, claim disputes are pressure, household budgets are pressure. The question is not whether pressure exists, The question is whether the system can release it safely. There are ways to reduce the danger. Homes can be hardened, defensible space can be maintained, communities can improve evacuation routes and water systems, utilities can reduce ignition risk, insurers can recognize mitigation, regulators can require real market participation in distressed areas. The FAIR plan can be modernized. Claims handling can become faster and clearer. Homeowners can be given better information before a disaster, not after a denial. None of that is hopeless, but none of it is automatic. A system does not become resilient because leaders announce resilience. It becomes resilient when the smallest points of failure are strengthened before the next load reaches them. The small point may be an attic vent. The small point may be a wooden fence. The small point may be a one-lane evacuation road. The small point may be a claim form. The small point may be a renewal notice. The small point may be a family that can no longer afford the policy that keeps the mortgage alive. That is the lesson of this story. System risk does not always begin with the largest object. It often begins with the part no one looks at until it bends. For California, the part bending now is not only the forest, the hillside, or the canyon edge. It is the recovery bridge. Insurance is supposed to make catastrophe survivable. It does not stop the ember. It does not cool the wind. It does not rebuild the house by itself, but it gives a household a path after loss. It turns a burned structure into a claim. It turns a claim into money. It turns money into temporary shelter, debris removal, repairs, rebuilding, and time. When that path narrows, the disaster widens, not all at once, one policy at a time, one zip code at a time, one claim at a time, one family at a time. That is why the $19 billion wildfire events matter, but they are not the end of the story. They are the headline number. They show the scale of the past. The hidden number shows the shape of the future. How many households can still find ordinary coverage? How many must rely on the last resort? How many can afford the premium? How many can survive the claim delay? How many can rebuild before leaving becomes permanent? The future will not be decided only by the peak flame. It will be decided by the bridge after the flame. A fire season will come and go. Some fires will be contained quickly. Some will be devastating. Some communities will prepare well. Some homes will survive because mitigation worked. Some reforms will help. Some insurers may return. Some households may leave the FAIR plan. Some claims will be paid quickly and fairly. But the thing revealed by the dashboard will remain. California is being forced to learn that wildfire is no longer just an event on the land. It is a stress test of the systems that decide who can stay on that land afterward. That is the future echo. The fire may pass over a ridge and disappear from the news. The smoke may clear. The evacuation order may lift. The burned street may be photographed, catalogued, and cleared. The official perimeter may stop expanding. The incident page may be archived. But the policy remains. The mortgage remains. The claim remains. The premium remains. The rebuilding cost remains. The question of return remains. And for the family at the kitchen counter, holding the letter that arrived before the flame, the map of California has already changed. It is no longer only a map of hazard. It is a map of insurability, a map of recovery, a map of who still has a bridge, who is being pushed toward the last resort, and who may discover that survival after fire depends on decisions made long before the smoke arrives. The event will pass, but the fault line it revealed will remain. A system built around old assumptions is being tested by a world no longer following the old fire calendar. The final question is not whether California can put out the next fire. It is whether California can still give people a way home after the fire is out.